All right, today we're going to tackle a really fascinating area of tax law. We're calling it the partnership tax puzzle. And we're going to follow the money, from how it's first accounted for, all the way to how it gets allocated to the partners.
Just a quick note before we dive in, this explainer was prepared by Samir Arashani, PhD, with some help from AI. So here's our game plan. First, we'll look at the partnership tax puzzle itself. Then, we'll get into the difference between accounting and tax income, a crucial distinction. After that, we'll see how you track a partner's interest. Then we'll put it all together in a case study. And finally, we'll touch on how other items are handled.
Okay, let's jump right in. Section 1, the partnership tax puzzle. Now here's the central idea, and it's a bit of a head-scratcher. You've got this entity that's earning income, sometimes a lot of it, but it pays zero tax.
So what is a partnership? Well, it's just two or more people getting together to run a business. But here's the really critical part for tax purposes. The law, the Income Tax Act, does not consider a partnership to be a person. And believe it or not, that one little detail is everything. It's the whole reason the partnership itself doesn't pay tax.
So that brings up a pretty big question, right? If the partnership pays no income tax, how does the government get its cut? I mean, how is that income actually taxed?
And the answer is what we call the flow-through principle. The best way to think about it is that the partnership is just a pipe, or a conduit. All the money, the profits, the losses, the deductions, none of it gets taxed inside the partnership. Instead, it all flows right through that pipe and ends up with the individual partners. They're the ones who report it on their personal tax returns.
Okay, so that naturally brings us to our next section, accounting versus tax income. Because to figure out what actually flows through to the partners, we have to bridge the gap between two different worlds, the world of accounting and the world of tax.
You see, a partnership will create its financial statements, using standard accounting rules. And that gives them a number called accounting net income. But, and this is a big but, that is not the number that gets passed on to the partners. We have to do a special calculation, a reconciliation, to get to the number that the taxman cares about, the net business income for tax purposes.
Let's look at a simple example here. We start with our accounting net income, say $100,000. Now the accountants deducted something called amortization expense, 20 grand. For tax, that's not allowed. So we have to add it back. But the tax system has its own version of depreciation, which we call capital cost allowance, or CCA. In this case, that's a $40,000 deduction. So you see what happens? We start at 100, add back 20, subtract 40, and we land on $80,000. That is the magic number. That's the net business income for tax, and it's the only number that gets allocated.
All right, which leads us to our next big idea, Section 3, tracking a partner's interest. And we do this using a really important concept called the adjusted cost base, or ACB.
So what is the ACB? Well, you can think of it as the tax cost of a partner's investment in the business. It's not a number that's set in stone. It goes up and down over time. And why do we care? Because if a partner ever decides to sell their piece of the partnership, the ACB is the number they use to figure out if they made a capital gain or a capital loss.
Calculating it is actually pretty straightforward. You just follow these steps. You start with whatever the partner originally put into the business. Then you add their share of the taxable income that we just figured out. And finally, you subtract any money they took out during the year. And boom, that's your new adjusted cost base.
Let's plug in the numbers from our last example. Let's say a partner put in $10,000 to start. We know the taxable income was $80,000, and let's say their share is 40%. That's another $32,000 added to their base. But they also took out $5,000 for personal use, so we subtract that. At the end of the year, their adjusted cost base is $37,000. And again, if they sold their interest right then, that's the cost they'd use for tax purposes.
Okay, now let's get into a more detailed case study to see how all these pieces fit together. Section 4 is all about income allocation, and we'll be looking at a partnership between two people, Rick and Kelsey.
So Rick and Kelsey's business shows an accounting net income of $625,000. But we know that's just the starting point. We've got a bunch of adjustments to make. We have to add back all the stuff that accounting allows but tax law doesn't. Things like half of the meals and entertainment costs, or club dues. Those get added back. We also have to add back this $48,000 capital loss. We'll deal with that later. Same goes for the $23,000 in charitable donations. Why? Because those flow through directly to the partners for personal tax credit. They aren't a business expense. And of course, just like before, we add back the accounting amortization. Then, on the other side, we get to deduct the things tax law does allow, like the capital cost allowance. So, after you do all that math, adding things back, subtracting other things, where do we land? The final net business income for tax purposes for Rick and Kelsey's partnership is $721,000. That is the pie that we now have to slice up and allocate between them. So how do we split that $721,000? Well, you have to look at their partnership agreement. It says first, there are some priority payments. You can think of these kind of like salaries. Rick gets $50,000 and Kelsey gets $25,000. That's a pretty common way to account for different amounts of work or investment. So after those payments, whatever is left over is split based on their profit ratio. 40% for Rick, 60% for Kelsey. When you run the numbers, Rick's total share of the business income comes out to $308,400, and Kelsey's is $412,600. And those are the numbers they'll each plug into their personal tax returns.
All right, on to our last section, handling other items. Because a business does more than just earn income, right? And the good news is that same flow-through principle applies to all this other stuff too.
Here's a really important rule to remember. Items retain their character. What does that mean? It means business income that flows through to a partner is still treated as business income. A capital loss that flows through is still a capital loss. And a charitable donation, you guessed it, it flows through as a charitable donation. The partnership doesn't change the nature of the item, it just passes it along.
Let's go back to Rick and Kelsey. Remember that $48,000 capital loss we added back? Well, only half of that is allowable for tax purposes, so that's $24,000. Their agreement says they split these things 50-50. So Rick gets a $12,000 allowable capital loss to use on his tax return, and Kelsey gets one too. Same deal with the $23,000 charitable donation. They split it down the middle, so they each get to claim $11,500 towards their personal donation tax credit.
Okay, so let's quickly recap the big ideas here. Number 1, partnerships calculate income, but they don't pay tax on it. 2, the accounting number is never the tax number. You always have to reconcile. 3, the partners are the ones who actually pay the tax. 4, we track a partner's investment using that key number, the adjusted cost base, or ACB. And finally, number 5, everything that flows through, from income to losses to donations, keeps its original character.
And that brings us to a final, really practical question to think about. Since we know everything flows through directly to the partners, and different types of income are taxed differently, how could you write a partnership agreement to actually manage the tax situation for the partners in a smart, strategic way? That's a huge consideration for anyone involved in a partnership. Thanks so much for joining me for this explainer.